So I'm super excited to share with you our scalping strategy, and we're going to talk a little bit about how this works specifically inside of funded accounts. I don't know if you guys are familiar with funded accounts, but we'll talk about that a little bit more in depth here in just a second. But first, this presentation is for educational purposes only and does not constitute financial advice. Trading involves risk, significant risk, and is not suitable for all investors. The decisions you make and the actions you take in trading are solely your responsibility. Past performance is not indicative of future results. Understand and acknowledge these risks before participating. So first, let me tell you a little bit about who I am and why I'm qualified to even be talking here. And I'm joined by my co-host, Tracy Lynn. Hello, Tracy Lynn. And so I'm going to first just tell you a little bit about me. I've been a stock and options trader and futures trader for 10 years, a little over 10 years now. And I've been working with trading automation for about 8 of those 10 years. I was the former CTO of Real Life Trading, and I'm actually been a speaker at the Money Show for the past 5 years. Been into Vegas, been to Orlando, headed to Dallas next month. So I've been talking and sharing strategies for a little bit now, a month of Sundays. So what we're going to do is we're going to talk about the scalping strategy specifically. And if you guys are ready, let's go ahead and dive in. So the first thing to know is that we use 3 different moving averages. Now there are different kinds of moving averages. In this case, we're talking about EMA. EMA just stands for exponential moving average. And exponential moving average is basically what that means is it's not like an average, like a straight average, it's weighted. So it's weighted a little bit more relative to the more recent candles, the more recent time frame. So what we're doing is we're using 3 different EMAs, right? So you can imagine 3 different moving averages that are weighted differently, and they look something like this, right? Typically, you have all 3 lines kind of going in the same direction, right? So that's what we're looking for, all 3 lines in the same direction. Now, why is it the 8, 21, and 50? So we actually have run a lot of back tests and a lot of computer modeling. The numbers itself aren't as critical. You can vary some of these, but just for our argument's sake today, we're going to pick these 3 and just run with them. So 8, 21, and 50. And so what that looks like is on a 5-minute chart, for example, then 8 EMAs looking back 8 candles, right? The 21 is looking back 21 candles, and the 50 is looking back 50 candles. There you go. Very good. So that's the idea. And that's kind of the very first step for our strategy. Okay. Now, the second step is we got to figure out what direction we want to go and what direction the market and the moving averages are telling us. So, for example, if price action is above all of the moving averages, so if you can imagine these are some candles, and our pricing is above all 3 of these, and they're all going in the same direction, all pointing upward. What we want to do is wait for a little bit of a pullback and then a continuation higher. And we're going to get in somewhere during the pullback and a kind of a move higher. Okay. Now, the reason that we're waiting for a pullback is you guys have probably seen, like, what happens, like, why do we need a pullback? Why can't we just jump to the end? Well, you guys have probably seen what happens when you have, like, let's say 7 green candles in a row. You can almost guess maybe what's going to happen next, right? Are you going to have 8 green candles in a row, or would you bet money that you're probably going to get a red or a bearish candle at some point? Okay. Now that's a very, very important detail. Why? Well, we have to wait for the pullback in order to get a little bit of a rest and then a continuation higher. Okay. That's very, very, very important. We don't want to jump in, be the guy who bought Bitcoin at the all-time high. We don't want to be that guy. We don't want to be the guy who buys at all-time highs ever, not just Bitcoin, but at all ever. Right? We don't want to be that guy. We don't want to be that girl. Okay. We don't want to be that person. So that's the idea for going long. And we got some examples we'll show you here in a sec. Okay. The opposite of that, of course, is price action. Our moving averages are all going lower. So in our example, we're going to have like 3 different moving averages all kind of pointing lower, and our price action is going to be, somewhere down here, right? Price action is lower. So again, same thing. We're going to wait for this pullback, and a pullback in a bearish move would be a little bit of a pop, a little bit of a bullish move, and then a continuation lower. So what that typically looks like is something like this, where it goes lower, it pulls back a little bit, and then continues forward. And that's where we're getting in, somewhere right around here. And we'll talk about that, the specifics, the mechanics of that here in just a second. Okay. Uh, so that's kind of how that works. So let's take a look at an example. Let's take a look at, let's start with a let's start with a short example. Sorry. So in this case, we have 3 moving averages. In this case, I made them 3 different thicknesses. So you'll see this is my 8, this is my 21, and this is my 50, okay? And I believe this was right off a 5-minute chart. And what we're looking at this exact example, I believe was M and Q, if I'm not mistaken. I have to go back and double check what screenshot we got this from, but this is basically M and Q, okay? And so what you'll notice here is on our screen, we have some very, very specific lines that are drawn out. Number one is this kind of teal line right here. You guys see that teal line? It's kind of dotted right here. So what we're looking for is we're waiting for all lines going down. In this case, you guys could say, check, that is true. That is so far so good. We're going to use the bullish candle as our bullish candle right here is our signal candle. What does that mean? Well, that means, again, we're waiting for a down move. We're waiting for a little bit of a pullback, and we're waiting for a continuation lower. Okay, now that pullback is what most people skip, right? Imagine jumping into the trade like the moment it goes a little bit lower right here, and then it's moving against you almost immediately, right? That's why we have to wait for that pullback. And so in this case, we're using the bullish candle here as our signal candle. We'll talk about that just in a sec. And then the other thing you might notice on the screen is obviously our entry is this dotted line right here. The other, it's kind of hidden behind, you see a little bit of a red line right up here. It's kind of dotted or dashed. That is our stop loss. Now, this is what we want to know before we jump into a trade is where are we going to get in where are we going to get in? Where are we going to get out for our stop loss? And then, of course, our take profit, our TP or our take profit would be down here. And that's this dark green line. And sorry, I can't draw a straight line freehand very well anymore. So, and then what you'll see is we have about 3x, right? So we're going to go about 3x. So we're going to basically risk $1 to make $3. Or said a different way, we're going to risk $100 to make $300, right? Or 1,000 to make 3,000. We're going to basically have a 3-to-1 risk reward ratio. Now, obviously, you guys can see how this played out. So the way that this works is we're waiting for that pullback. And then wherever this closes, if we kind of go below, wherever it closes, where we're going to jump into a trade. And so what we're going to do is we're going to basically do, in this exact example, we're going to market sell. Now, you guys may be familiar with market orders, but we're going to market sell right here at this level. In this case, you'll see we're using, in this case, 2 contracts. How did we know to use 2 contracts on M and Q instead of 3 or 5 or 10? Well, what we do is we use what's called fixed risk. We want to define how much we're willing to lose if we are wrong. And in our example, let's say we're going to lose $100 if we are wrong. And if we, actually, let's do it this way. Let's do it as a loser. If we lose, we're going to lose 100. But if we win, we're going to win a multiple of that. We would say 3x or 3 times, or we would say 3R, 3 times of whatever we are risking if we're wrong. So if we lose, we lose 100. If we win, we're going to win 3 times that, or $300. Okay. So in this case, what happens is we market in and price action. As you guys can see, the very first candle, we're in the trade, we're profitable. By that third candle, we're losing a little bit. And then you'll see kind of this zigzag up and down, up and down, up and down until we finally hit our take profit at the bottom. Now, do you have to use a 3-to-1 risk reward ratio? No, you don't. That is kind of our preference. You never really want to risk $1 to make $1. And if you do that, you need better than 50-50 odds, right? So if I risk $1 to make $3, I really need something above a 33.33 win rate. You guys agree? Just to kind of make a little money to break even, right? I need a little bit better than 33.33. Now, with a let's say a 1-to-1 ratio, I need 50% plus win rate, right? If I'm going to risk a dollar to make a dollar, that's, ladies and gentlemen, that's why I don't really ever like to risk a dollar to make a dollar. I want to make more than what I'm risking, right? And so even with 50-50 odds, I'm going to be profitable over time. So let's play out how this works in our example. Of course, you guys can see in this very first candle, we are wicked in right here. You'll see that the price action went higher and then lower. It got in right at the close of that candle right there. And technically, you can't get in at the close. It's kind of like essentially the open of the next candle, technically, because once a candle is closed, you can't unopen it, right? So we get in right here at this candle. And I'm curious, ladies and gentlemen, how much do you think we're up in profits? If we're risking, let's say $100 risk, how much are we up by the low of this first candle? How many dollars do you think we'd be up? If this section right here represents $100 of risk, how much do you guys think we would be up if price action is down here? I'm curious if you throw it in the chat, go ahead and let me know how much profit would we be up if we're down, if we're short and we're going, price action is going lower, right? We want to always go towards our green line and away from our red line. I'm curious, how much would we be up? So sorry, at the so nope, we're not negative. We're actually positive at the end of this. So we get triggered in here and we go down to here. So we're going to be up roughly $100, right? Basically $100 down here would be about plus 200. And then our final take profit would be right at that plus 3R or $300 level right down there. Okay. So, but here's what's crazy is we're up 100 and then we're up to here and we're down $50. Maybe that's what you were looking at. Jason was minus 50 is probably about right there. We're about minus 50. So you go from like being up 100 to down 50. How many of you guys can handle the emotions of watching it be profitable, more than the, at the $100 risk level, you're up that amount or 1R, and then you're down 0.5, half an R. How many of you guys can handle the emotions of that? Not many. I'll just tell you that. And it comes from years and years and years of practice. And what you guys, if you've been trading any amount of time, you know that it's not really the strategy, it's more your emotions than anything. So at this point, what we do is we put our stop in. Once we're in the trade, we put our stop in. This, again, we're on M&Q. So we're going to put our stop about 40 ticks higher. And then we're looking for about 120 tick move, right? Boom, 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 something like that, right? So this is our plus $100. This is our plus 200, and this is our plus 300. Again, the idea here is that all this is calculated in kind of predefined risk. It's defined risk. It's not like, oh, if it moves against us, we're going to double and triple our position, because that is not a smart way to do it, especially if you're using funded accounts. Why? Well, funded accounts have very, 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 did I say very rigid rules for getting an account passed, right? You have certain risk, reward, profit targets, how much you're allowed to lose and draw down. Like they got some pretty rigid rules you have to follow. And in this case, you'll see, we'll talk more about that in a sec. But in this case, again, we got in right here at the market order, and price action moved in our favor, then against us, and then actually, you guys want me to really draw out what happened. It went lower, then it went higher, then it went lower, then it went higher, and then it went lower, and then it went higher, and then it went lower, and then it went higher. Boom. Now, what do you notice? Price action never moves in a straight line. It looks like a heartbeat monitor is what that looks like, right? So again, if you can't handle that, then obviously having some kind of automation or something is an easy, simple way to kind of handle the emotions of this, okay? So that is my short example. Let's jump in. Let's take a look at a long example. Pretty much same thing in reverse, the other way around. So in this case, these are actual, this was our bot actually took this. This was 10 contracts, and this was using bot number 66 in this case. And I think yeah, the other one was 66 as well. So here's how this works, okay? Is we're looking for all three of our moving averages going in the same direction. You guys can agree when we got in right here, all moving averages were going in the same direction, right? They're kind of like fingers, all parallel, like railroad tracks, except several sets of railroad tracks. And what we're doing is we're looking for price action going in a flow, pulling back a little bit. Remember that pullback is super, super important. If you guys have ever hiked up to the top of a steep mountain, you know before you hit the very top, you might want to take a little rest. That's essentially what the market is doing right here, right? So price action moves higher, it pulls back a little bit and then continues on. But at this point, right here, where we're getting in, our moving averages have already kind of, they started normalizing, started going parallel again, right? So and then what we're going to do again is we're taking this candle right here. We're going to get in at the close of this candle, or technically the open of the next one. Same exact thing. Our stop loss is our red line down here. And let's do that in red. Our stop loss is this red line down here. Our entry is right here. And then our take profit level is up here. Now, if you ever get confused about, do I want price to go higher or lower, this example, in this case, we always want it to go, in all cases, we always want to go towards the green light. If you think about green lights, stop lights, if you guys are familiar with green lights, red and green lights driving like on the road, same idea. You want to go towards the green light and you want to go away from the red light. That's essentially what this is. And same exact thing. If I am, let's do a little bit different number. Let's say I'm going to risk $250 per trade. Okay. So if I lose, I'm going to lose $250, right? If I lose, but if I win, I want to make 3x, 3 times that. So I would win plus 750, right? Can you guys see that? So essentially what I'm doing is I'm getting in right here, and the distance, I want price action once I'm in, I do not want to get in and go lower, right? Because this is a long example, this is a bullish example. I want price action to go higher, again, towards the green line. So I'm going to jump into the trade. Again, I'm going to mark it in. So this would be basically like, I would basically be like market by 10 MN, oops, 10 MNQ. That's basically what I'm gonna do, right? And I would have that, I would throw that order out. Once it's filled, which is gonna be filled in a nanosecond, literally, then once I'm in that, then I wanna go ahead and throw out my stop loss and my take profit. I wanna throw those orders out. Why? Because I automatically want to have my risk fixed. I don't want to lose more, in this case, more than $250 in a trade. That's it, right? And so again, essentially what I'm doing is I am just basically allowing the price action. I'm allowing this setup to work in my favor, okay? Now what you'll notice is once I'm in the trade, and let's pretend again, this is a 5-minute chart. I do have a question for you guys. If this is a 5-minute chart and I got on right here, how many minutes was I in the trade before we hit our take profit? So 5, 6, 7, about 8 candles. How many minutes was I in the trade until I hit my take profit? So 8 candles, 5 minutes each. I'm curious if you guys can do the math. 8 candles, 5 minutes. Each candle is a 5-minute chart. So 5, 10, 15, 20, 20, 40 minutes. Yep. So we're in this trade 40 minutes. So would you guys click a few buttons to make $750 in basically 40 minutes? Now, obviously, you can watch every little tick play out, or you can set up the trade and walk away, and whatever happens, happens. Now, I will promise you, the more you micromanage it, the more it will move against you. I don't know why that's a thing, but that's a thing, right? Set it up, put in your stop loss and your take profit, and then walk away. That's the easy thing to do. So let's walk out the rest of our rules. Again, we're going to use our bearish candle as our signal candle, which is right here, this candle right here. And a signal candle just means what's the candle we want to use to get our entry? Like what candle are we using as like a template to get in? So in this case, we're making higher highs, and we want a pullback, right? We want a pullback to come in and then kind of a continuation higher. Is this making sense? Let me know if this is making sense. Again, 40 ticks and about a 3 target is 3R. So 3R target. What does 3R mean? Well, remember, if we're risking $100, 3R would be $300, right? If we're risking 250 and we're looking for a 3R target, we're risking 250 to make 750. Now, before you say, Matt, why don't we just bet it all on one trade? Well, what happens if that trade loses? And ladies and gentlemen, that is why we're very, very particular about how much we're going to risk per trade, because you shouldn't be nervous, you shouldn't have sweaty palms, and your heart shouldn't be racing on one single trade. Why? Well, one trade shouldn't make or break you. And if it is, you're taking way, way, way too much risk. Now, it's okay to be a little nervous. If you're a new trader, it's okay. But one trade shouldn't make or break you, right? One trade shouldn't destroy your whole account. One trade shouldn't blow up, right? One trade shouldn't kick you out of the game. That's the idea here. And that's why we prefer what we use, or what we call is fixed risk, okay? Fixed risk, okay? So let's take a look at, in this example again, we got in, price action moved higher, and pretty simple, in and out in about 8 candles. I was curious how many candles our last one was. A few more than 8, I believe. So we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So a little bit more. A little over an hour there on that one. Okay. Awesome. So let's jump in. Let's continue on. So as you guys can tell, the strategy itself is pretty simple. It's not hard, but that discipline, being patient, that discipline's the hard part. Why can't we just be disciplined? Why can't we just be patient? And this is where I see a lot of people, especially funded account, they change their risk after losing. How many of you guys are guilty of that? How many of you guys are guilty of changing the risk when you get into a trade and you lose? You're gonna like double and triple it. Yep. So got a question. I don't understand what the green and red lines are in the candles. The green and red lines. Are you talking about these? This is basically like where our system is telling us to get in, get out based on our strategy. Is that what you're asking about? Or are you talking about the moving averages? These are moving averages here. This is the 8, the 21, and the 50 EMA. Yeah, let me know if I can clarify anything. Otherwise, we'll circle back. Okay. The lines are actually in the rectangles. I'm not sure what you're talking about. The lines that are actually in the rectangles. The lines that are in the rectangle. Are you talking about these? These are candlesticks. So this is the candlestick. Okay, yeah. So these are just candlesticks. Okay, so yeah, so the up, these are wicks. So this is basically the high of the candle. This is the low. And then red and green have your open, high, and low, and close or reverse. But ultimately, it's showing you like I always think about a candlestick is kind of like it's like tire tracks in the dirt, where you can see where price action went. And so if we were to let's just look at this candle right here. You can see it opened right here. Put an O for open, opened right here. It closed right here, but then the high would be right here and the low would be right here. And these lines above and below represents wicks, and that basically is where the price action went, but then receded. So that's like the tire tracks and it's like where it moved, right? So the difference is like if you ever look at like a line chart like on Yahoo Finance, they'll show you a stock price like this. And what that just tells you is where the price closed. That's one piece of information. I don't know about you, but I prefer 4 pieces of information. I'm going to know the high, the low, because the shape of these and patterns actually tell you a totally different story than just where it closed and only where it closed, right? So that's kind of the idea. Yep. Okay. So again, being disciplined is the hard part. The strategy itself is not very, very hard. Not following strategy or violating daily loss limits. So I'm curious, put in the chat pane, how many of you guys, like what specific funded account programs have you used, or what are you familiar with? Now, the reason that we like funded accounts just to start with, we're not trying to live off of funded accounts, but the reason we like to start with funded accounts is that it allows for cheap mistakes. Funded accounts allow beginner traders to make cheap mistakes. So, ladies and gentlemen, yours truly. Funded accounts are cheap mistakes. Why? Well, let's think about this. If we were to set up a funded account, and let's say that this is Lucid. Actually, this is a lot of the funded accounts, but let's say Lucid, there's Apex, there's a lot of them out there. And as long as you work with, like, it supports NinjaTrader 8 or Trade of 8, then it can use our systems pretty easily. But let's take a look at this $50,000 account. Let's say I'm going to pay $100 for that, just for easy math, $100 for a $50,000 account, right? Now, the idea is I have to grow that account $3,000 without losing $2,000. And I have a limit of, I can only lose 1,000 a day, max. That's my max I can lose in a day, right? So what you'll notice here is you're like, dang, if you were to take 50,000 real money, let's say you got a bonus, heck, a really good bonus from work, you got a bonus, maybe it's a inheritance, and you actually lost $2,000 of that. That would cost you $2,000. Well, the funded account losing that only costs you $100. Ladies and gentlemen, this is one of the major benefits to using a funded account. Is why? Well, if you were to lose 2,000 of your own real money, your 50,000 would become 48, right? Right? But if you're using a funded account, you're only losing $100. And you can go spend another $100 and get another funded account. Ladies and gentlemen, that is one of the humongous benefits of using funded accounts, okay? Again, you have some limits, some rules you have to follow. And basically the way it works is you grow that account and depending on which funded account program you're with, but let's say you're with Lucid, one of my favorites, Lucid, there's no time. You don't have to do it inside of 30 days. You can take as much or as little time as you want, and you pay a one-time fee of, it might be 125 now, but let's say $125. One-time fee, $125, as long as you want, okay? Now you can go to Apex, and Apex will show you shiny, maybe it's $35, but you have 30 days to do it, which means you have an exponentially more difficult time to get an account funded because you have to do it inside of 30 days. And that's with Apex, and this is Lucid, okay? Now, the reason I don't mind paying a little bit more for Lucid, or in this case, like 3+ times more, is there's an unlimited amount of time that I can use, unlimited time, in order to get an account funded. Now, ladies and gentlemen, would you rather lose 2,000 or would you rather lose 100 or $125? I don't know about you, but I'd rather lose the smaller amount, right? Okay. So the idea here is that we're able to risk anywhere from $100 to $250 per trade, and we want to define what that is when we start. And the idea is, again, fixed risk. We're not going to just jump into anything with 2 contracts or 1 contract. We want fixed risk, meaning we're going to have a set amount of money we're willing to lose and be okay with that if the trade doesn't go in our direction, okay? Now, here's the trick. Ready? If you're taking notes, write this down. A loss on a trade should feel like a paper cut. It should not cut you to the bone, and you should not bleed out over one trade, okay? It should be a small paper cut. Now, yes, you could still die by a million paper cuts, but my point is it should just have a tiny sting, not the end of the world. You should not lose sleep over it. Otherwise, you are trading way too much size, way too much risk, okay? So what this is saying is, in our example, we actually had 3R targets, and we were making 750, or if we were to do it the other way, we were going to make $100 for $100 of risk, $200 and $300, right? Again, the idea is you want to make a multiple of how much you are risking. This is a $100 risk. This is $250 risk. Okay. And again, just a couple consistent trades just work out over time. And next thing you know it, you're here at your profit target, and then you get a what's called a PA or performance account, and you grow that account, and now you're eligible for one of my favorite things, which is payouts, which is you say, hey, you know what? I got $4,000 of gains in my account. I want to take half of that out. Send me a check for $2,000. That's how payouts work. Okay. Just as an example. That's how you get real money out of funded accounts that you only paid $100 for. Now, how many of you guys would love to spend $125 and withdraw 4,000? Yeah, but it's way harder than it looks. Those of you who've been trading for any amount of time know that. It's not as simple as it looks, right? Someone told me once, like, Matt, how hard can it be, Matt? You're just clicking buttons. And I would say same thing with like writing computer code. You're just clicking buttons. It's way harder than it looks, of course. Just like Tiger Woods makes golf look way easier than it really is. Of course, the pros make it look easy, of course, right? That's just how it is. Okay. So what I want to do is I want to ask you guys a couple like hypothetical questions. What if like this strategy that we've been talking about, we've been talking specifically about the scalping strategy. What if we were able to execute it automatically for you? What if the risk was fixed? What if you never missed a trade or breakout or like up or down, bullish or bearish? What if you never lost any, missed any opportunities? What if you could copy all your accounts up to 20 evaluation accounts? What if you could do all that all at once? That's kind of what our company does. Now, yes, we do teach the strategies for you. That's kind of what we're talking about, but we actually have it take it another step further. Okay. So those of you guys who have manually traded before, these are the common challenges that happen is you're going to hesitate at your entry. You might enter the trade a little late. You might double down on your risk if you have a loss because you want to hurry up and get back to break even, or you may remove a stop loss. Has anyone ever done that before? Anyone removed a stop loss? So I've actually done that myself. I remember being down $1,500 on a trade one time. Okay. I did not want to take my loss, so I removed it. And ladies and gentlemen, that mistake, $1,500 didn't want to take, cost me multiples. It cost me multiples of 1,500. It cost me 6,500. Now that's why you use a stop loss, right? That's why you use a stop loss. Those are your breaks to make sure you can survive and continue trading to the next day. Now this is our approach. We have a very different approach. Most people who are like engineering minded or very logical kind of gravitate to what we do, which is more systematic. Saying, hey, I want to have rules for why I'm entering a trade. I want to know exactly why. I don't want to just jump in right here because it looks good, because it feels good. Like that's tough to teach other people, especially new traders. Jump in now because it just has a good feeling to it, right? I once asked one of my mentors years ago why he got into a trade, and it was some smart aleck answer to the effect of 15 years of experience. And ladies and gentlemen, how does that work if you're talking to a brand new trader? You just flex and say, well, it's my 15 years of experience. How do you learn from that, right? So in this exact example, of course, we're going to have the same size every time. We're going to risk the same amount every single time. And then our stop losses are exactly where we've calculated them. And we don't bring any emotional baggage to the day, trading day, right? Everything that happened last week, it's all, systematic. It's all rule-based, right? So this is what we do. We have pre-built algorithmic trading systems, and we have they have a portfolio of trading bots that have all the built-in risk management. We're one of the only companies that I'm aware of that builds trading technology and automation specific for funded accounts that is not part of MetaTrader, okay? And the reason we do that is because funded accounts have two very, 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 very specific things you have to manage. One is you have daily loss limits and drawdown. So you have very specific amounts you're allowed to lose either over the life of the account or in a single day. And you have to be in cash at the end of the day. Those are two very, very different things that you can't just take any bot that is not meant to work in funded accounts and apply it to funded accounts. It won't work because it's not following the rules. Why? Because it wasn't built to follow those rules, right? So the idea here is that we're able to take different market conditions, whether it's trending, range bound, high or low volatility environments, and we're able to build, like, we have multiple strategies that we can combine, and we can kind of have smoother performance, and we can kind of adapt to different and changing market conditions. And the idea here is that we're not using one trading bot. Most trading companies, trading automation companies, have a single bot. That's it. One bot, that's it. Take it or leave it. It's going to have winning streaks, it's going to have losing streaks. Now imagine if you had like a bunch of different trading bots that worked in different conditions that you're able to mix and match, like these different conditions, and they work well over time. Some work better than others over time, but they kind of balance each other out. That's what we're talking about when we're talking about smoother performance. Instead of having like win and loss streaks that look like this, it's more of a smoother, gentler approach for growing your accounts. Now, of course, the strategy here that we've talked about, the um, scalping strategy, it is all rule-based. You can scale using our technology. You can scale up to 20 accounts. So Apex allows you to have up to 20 accounts. Lucid allows up to five accounts. Lucid's one of my favorites. That's the only downside that I've found, is they only allow you to have up to 5 accounts. Maybe that'll change in the future. Apex is 20 accounts. Everything's defined risk, and then we have some built-in tracking so you can see how well your accounts are doing if you have multiple accounts or multiple portfolios. So ladies and gentlemen, what we're talking about here is a structured rule-based system where, imagine what would happen in your trading if you were to remove the emotional decision making, like remove you from the process and just let the technology, let the strategies work. And that's literally changes. Why that's important is why, because it changes everything. Again, most traders struggle because they lack knowledge and they don't follow structure. They react, second guess, and most of the time they override their own strategy. So what we've done is we built some automation around these strategies, and this strategy that we're teaching today, the scalping strategy, has been one of 6 different strategies we've taught over the past 2 months. So we've taught every single one of our strategies openly. It's not a secret. There are some variations, of course, some complex things that we do with the strategies, but the basic vanilla version is kind of what we've been teaching here every couple of weeks. Okay. So why do I want to use automation, Matt? Why can't I just like click a button and make tons of money? Well, for those of you who've been trading for any amount of time, you know it's not that simple. I wish it was that simple, and life would be so much easier if it was that simple. But guess what? If it's easy, then that means everyone else is doing it. So technically, you don't want it to be easy, right? So there's 3 major advantages we found when it comes to using automation. One is discipline, of course, is going to execute the strategies exactly. The other thing is it's very, very fast. So it's going to throw out orders before you can even blink. It's in and out of trade sometimes, especially the scalping strategy. We have something called a mega scalper. And then, of course, it's going to operate without any emotional baggage from you on your end. Okay. Now, the cool part about all this is that because this is designed for funded account programs, it does have some risk management built in, and that is not at all optional in funded accounts. You have to have this. So we have defined position sizing. You can use different strategies that work in the different environments, and some funded accounts call these the DLLs, the daily loss limits. In our example, we were looking at a few slides ago, you're able to lose on a 50K account, you're able to lose $1,000. That's it, max. Well, if you do, you blow up your account. If you don't, you keep going, right? And then we're using fixed risk per trade. We prefer somewhere between 100 to 250 on a funded account that's 50,000. Now, some of you guys have probably seen, I'm curious what funded account sizes you've used. Now, the common sizes are anywhere from 25 to about 150, 150K. Yeah. So you guys can do the math. If you had 20 of these accounts, or if you had 20 at 25 or 20 at 150, you got some buying power essentially, right? And so essentially what we're doing is not just one trading bot. We actually have 6 unique strategies that have a bunch of different settings. And we spend anywhere from 30 minutes to an hour every month on each one of every single one of these to find what are the optimal settings. And then you can mix and match. And that gives you not millions, but actually it's hundreds of trillions of possible combinations. So you imagine 430, how many can you mix and match? So imagine a bucket of 430, you reach in, you pull out a handful of 8 or 9. How many possible combinations can you mix and match when you have a bucket of 430? It's trillions, hundreds of trillions of possibilities, okay? So we're not just saying, hey, we got a trading bot here, you just use our trading bot. It's actually an entire suite of portfolio tools. So I did include, sorry if this comes through a little bit blurry, but we're actually running this is our actual, one of our software tools that we built. And it shows if you build a portfolio, and I don't know if you guys can see, but it says $50,000 account, right? $2,000 of drawdown and a $3,000 profit target. And how many times, if I was to run that and have 20 of them, how many times would I pass? And given this exact portfolio that we're using, again, remember, hundreds of millions of variations, this is saying you would have passed 20 times, failed 10 for about 65% pass rate. Now that's pretty impressive. I can actually show you screenshots of other ones that have 100% pass rate. The downside is it doesn't always do it inside of 30 days. For those of you who are looking at Apex, you have to do it in 30 days. So it doesn't always do it in 30 days. So they kind of force you to be a little more aggressive. But this is showing over the course of 4 years. So we go back 4 years, back to 2022. You guys remember what happened in 2022? Those of you who are US citizens, we had a totally different administration in the White House. I'm not commenting on whether you like the current or the previous administration. That doesn't matter. My point is, very different time frame in 2022, right? Stocks were falling off a cliff. Things were going lower, lower, lower. Tech stocks were down sometimes 60, 70, 80%, right? And then now things are just, we're reaching new highs always, it seems like, right? So my point is different market environments. And that's why we're going back. We basically go back 4 years. It's going back 4 years. And this is a single account. Imagine this times 20, right? So we're going back to the beginning of 2022, January 2022, and we're running simulations showing how well these exact strategies that we've been teaching the last, 6, 12 weeks, how many of them are, like when you mix and match them, how many of them work and how well you can put together a portfolio and pass like a funded account. And I apologize for that coming through blurry. I'm not sure. The screen was, I'm not sure why it's coming through a little bit blurry, but anyways, this is what we offer, ladies and gentlemen. If you're interested, is you can start with our technology, including the Mega Scalper, which is the strategy we're talking about today. And we do have a promotion here on the webinar. Is for $199, you get access to all of our trading bots and our settings and our portfolio builder tools, builder analyzer, and tracker tools. You're basically getting access to all of our technology except the trade copier, and it works on NinjaTrader 8. And you can do that for basically $199. Now, if you've looked at other trading bots, you've probably seen some of them that are up to 10, I've seen $25,000. We're not trying to get rich off of this technology. What we want to do is we want to put this at a retail price in front of the average retail person, and we want you guys to test how well this works. Well, I'm not asking you to make a buying decision. I'm asking you to make an informed decision, and you can really only do that from the inside once you got your hands on technology, so that you can play with some of this and see how all this works. So obviously we're limited on a webinar like this. 45 minutes, an hour, can't show you every possible thing, but that's kind of what we're offering. And we'll go ahead and throw the link to join this if you guys are interested in our, I'll throw that in the chat, but that's kind of what we offer. And if you have any questions, this is my email. I'll go ahead and pause here. If you have any questions, that's what I have for you guys. We do have plenty of upcoming webinars as well. If you're interested in hitting up any of our free webinars, we do them one or two a week. Sorry, one every week or two is what I should have said. So every week or two. Again, my name is Matt with Push Button Trading, and I will go ahead. Thank you for putting the workshop link out there. Yeah, but that's what I have for you guys. Any questions, let me know. I'm going to hang around for a little bit. Otherwise, that's kind of what we have for you guys. Have a pretty good audience here today. Yeah. Yeah, no problem, Carrie. Yep. Jason, Jasmine, hello. Tracy. Yep. Any questions? Go ahead and hit me. Throw them in the chat pane. Otherwise, that's what I have for you guys. And thanks for hanging out with us again. We actually have one more webinar next week if you guys are interested. And by the way, if you guys haven't seen some of our reviews on TrustBuy, so this is TrustBuy, a third-party review. We got lots of five-star reviews if you guys are interested in kind of checking us out. And we have got lots of cool technology that we've built that we're trying to introduce the average public to. So, yeah, the average retail trader. Yep, cool. Any other questions, ladies and gentlemen? Otherwise, that's what I got for you. Cool, awesome. Well, thanks for hanging out with us, and we will get this recording out soon. Thanks. Bye.